that. Bandhan Bank is the next company that I want to focus on. Numbers came through, and we have, the question with Bandhan, of course, it was a bit of a weakish quarter once again. The question is have we seen the worst? And will things start to improve dramatically over the next few quarters? That is the market expectation. We have Mr. Partha Pratim Sengupta, Managing Director and CEO at Bandhan Bank. Sir, thank you very much for joining us. Good morning, Prashant here. So my question is exactly that, sir. Have we seen the worst? You know, over the last few quarters, we've seen Bandhan kind of recognizing bad loans, etc., at a very accelerated pace. You know, taking all the pain in. Have we seen all of it with this fourth quarter numbers, and will things look much better from here out?
Precisely, I can say another 2 quarters will be a challenge, but not to the extent what we have seen in Q3 and Q4 of the last financial year, that is 24-25. The delinquency book is definitely improving, so the slippages would be much lesser. But yes, the microfinance segment, as you know, that the entire country has been affected, and we are also not insulated again from it. So a little bit of challenges would be seen in Q1 and Q2 of the current financial year. But Q3 and Q4, we are expecting a very good, I would say, for results from the microfinance segment. And definitely, I think going forward, the things will again be as better as we have seen in the previous 2 years back, especially in the pre-corona period. So this sector is showing improvement, but albeit at a little bit slower pace. That much I can say.
Q3 numbers, that is October to December, numbers should go back to where they were pre-COVID, basically, by Q3.
We are expecting that, yes, definitely there will be much improvement, Q3 and Q4 of the current financial year. Q2 and Q1, I would say that, yes, the slippages won't happen, but definitely at a much lower pace. The rate would be much low for that. We are seeing that there is a sequential improvement in our delinquency book, which is a very good sign.
Okay. All right. Hi, Mr. Sengupta. Good morning and good to see you in. Nigel on this side. Give us some numbers. How do you see the credit cost panning out for the remainder of this year? You're guiding that better times ahead. So in the first half of the year, what will it look like? And then how do you see a recovery from there?
So you see the credit cost for the entire financial year was 2.9%.
Yes.
And the way we are going forward, I think this year we may end up something around a little bit over than 2. So the entire year we are aiming at around 2.3, around that. But again, this will depend on a lot for that year. The first of all is that we have to decrease our loan loss provisions. So that will definitely come because we are now very adequately provided. You see our PCR ratio, including our write-off, is almost 87%. And without CR also, we are about more than 73.7%, so which is almost 74%. The microfinance book is almost close to 79%, the PCR. So we are sufficiently provided. So going forward, we are finding that with the improvement in our loan book, and that also you have seen that we are now turning more universal. We are going towards our secured books. So our secured books percentage has increased from 42% to 50%, 50.5% in the last year. And our target is that we should reach by 55%, in the next 1.5 years or 2 years further. So that is our goal. So with this secured book position, definitely, I would say the quality of assets would be better. The microfinance area of this segment is also showing some improvements. So from Q3, Q4 onwards, it will come. So our target is that within next 2-3 years, we should contain our credit cost and bring it below 2%. So that is our target for that year, and we are working on that.
So 2.9% comes down to 2%, and just going through a couple of notes, I believe that in the next 3 years,
this year will be around 2.3, 2.4.
2.3, 2.4, and then gradually you're looking to take it to around 1.5, 1.6 over 3 years is what I understand.
Yes,
Got
yes,
it. Okay.
absolutely.
So we
Absolutely.
got the near term and the longer term guidance. Give us two key numbers then, sir. What is your advance growth you're expecting for this year, advances, if you could help us out with that? And how do you see the
Yeah.
NIM spanning out as well?
So, number one, regarding advances, we are looking for a 15 to 16% growth for this year. And as we have aimed and we have also tried from last year and we have been successful, that our deposits growth would outpace the advances growth. So, deposits growth, we are increasing a little bit more than the advances. CD ratio, as you have seen, that we have brought it to 90.5% for that year. So, almost that same ratio will continue, but maybe a little bit high or low. Going forward for the NIM, you see the NIM would be moderated. We have told very clearly from Q3 onwards that as we are moving towards a secured book, our NIM would be moderated and it will be further moderated a little, but the volume would definitely increase so that there is an overall improvement in the actual figures in the profits.
Where should we, on a steady state basis, where should NIMs be? If you can give us some guidance.
So we are around 6.4. We are looking. We're steadily coming down. So you see, this quarter it was around 6.7. So it may come to around 6.4 around.
To about 6.4 or so. Got that. You said you should go back to pre-COVID kind of performance post starting third quarter, right? You would have recognized all the old stress, new stress, of course, we'll have to see and take it as it comes. And you're not alone, the industry is facing it. Could you give us a sense of, when you say go back to pre-COVID kind levels, what are we exactly talking about, sir? Just give us some sense.
Let me tell you, by pre-COVID sense, I want to mean that the slippages would come down substantially. That is the thing. The NPAs would be contained at a much more higher level. Number two, for the day. So, and this is, I'm talking about the microfinance sector. The other sectors, as you have seen, that our book is quite healthy, whether it is the corporate book, which has got a little bit more than 1% as NPA, so which is quite healthy for the day. The housing finance, whatever the NPAs are there, most of the cases are legacy cases, but that is also being now contained. In respect of the wholesale banking, and I have told you the other sectors also in the retail. So I think the book is quite better for that year. So there is no worry on those fronts. The only worry that is coming is from the microfinance fund, and where I was witnessing that the delinquency level sequentially is coming down. So that is a great signal that going forward will definitely come down.
All right. Very quickly, sir, before we let you go, your OPEX spend has moved up. I think you have guided for that, which took your cost to income ratio to around 54%. What do you end this year with? If you could tell us, because you have said you're going to continue to focus on that aspect. And also the ROAs are still very, very subdued. Where do you see the ROA headed? Both these two, cost to income ratio and ROA. Go ahead, sir.
So as regards cost to income ratio, while the Q4 is high, it has always been high. It has always been high in the previous quarters because, many of the costs come in the Q4. But if you look at the whole year figure, it is around 48.56%. So that is, I think, quite reasonable. So we have added people as we move into the other sectors of the businesses. We have also invested in technology, and there will be further opening of branches. And also last year also, I'm talking about 23-24, we have opened close to around 240-50 branches. So all those costs have added up on a full year basis during the previous financial year. So that has actually led to an increase in the cost income. But now we are waiting for getting returns from what we have invested. So going forward, I can say that while investments in our resources and investment in skills will continue, but definitely whatever we have invested in the past, that return would be coming. So the cost to income ratio would be contained, and it would be contained at the same level around 47-48%. That's what we are aiming at. This is the first thing. And regarding the return on assets, so you see the overall return on assets was 1.5%. Our target is that we should reach close to 1.8 as soon as is possible. But again, as I've told you that this year, maybe the return on assets will be around 1.5, 1.6 from the simple logic. Because previous year, Q1, Q2 has been good. Q3, Q4, there were challenges. This year, we are expecting Q1, Q2 will have a challenges, but at a much lower level. And Q3, Q4 would be good and maybe better than what we have done in Q1, Q2 for the last financial year. So going back,
Alright.
simple trade, I can say logically that 1.5, 1.6 ROA, we will be able to achieve this year.
All right. Thank you very much for joining us. Good speaking with you. It's a pleasure, having you with us with that perspective.